Alright, now we will discuss the summary of this chapter, the summary of trading support and resistance. First, we discussed in this support and resistance. Now, what is support? Support is the lowest point where the price reversed. And what is resistance? It is the highest point where the price came back down. So these are not exact price levels, not exact numbers. This is a zone. The price can go above this price zone with some momentum and then come back down. All right, we understood that this is a zone and how to draw them. For the test, we have to take the highest point, and for support, we have to take the lowest point. Another thing to understand is that when a support breaks, it can become a resistance, and most of the time it will become a resistance. And when a resistance breaks, it will become support. Most of the time, it will become a support. So what do we have to do? Because of this, we have to understand the things and apply the experience of trading them. Now, the second thing was psychological levels. What are psychological levels? They are round numbers and previous significant levels that attract traders and influence them in buying and selling. They have in mind that, oh, the price has reached 2600, 2500, so I should buy, I should sell. In this way, they develop a psychological behavior. Whenever prices approach these levels, what happens there? There are hidden orders, either to buy or sell. When the price reaches there, or the price is going up, or the price is going down, at these levels we can get reversals, stalling, consolidation, and potential breakouts. So we have to keep an eye on these levels and to predict trend lines and channels. What is a trade line? A trade line identifies trends. We discussed that when the price makes higher highs and higher lows and is in a bearish trend, we will connect its lows. If we connect two lows, it becomes a trend. When we connect three lines, we get a trend direction confirmation. It will be the same in bearish. Then there are channels. We have ascending, descending, and horizontal. Horizontal is the sideways channel, consolidation or ranging market, where the price will move up and down. You will not be able to draw a trend line. In some markets, a higher high will form, then a lower low, then another high, then a lower low, and then a higher high. That is called a ranging sideways market. Channels are drawn in it. The top and bottom of that range are identified. Then in the ascending trend that is going up, the ascending channel, the price rises from the bottom, and at the top of the channel, probably profit taking happens there, or the price falls back. So according to the channel, the price is overbought. We can use those tops for profit taking. In bearish trends, we can also use the bottoms for profit taking. This is what we call a channel. Now, what is the way to trade them? We have two methods. One is a bounce and the other is a breakout. What is a bounce? When the price reaches a level, it touches it. Suddenly, everyone was waiting there and it comes back. It is mostly used in counter trend trading or in a ranging market, in a sideways market or horizontal market. And the breakout method we have is used in trending markets. There are two approaches. One is an aggressive approach and the other is a conservative approach. In the conservative approach, what happens is that the price breaks the level, comes back, breaks the resistance, and comes back. It creates support, so it becomes bullish. And what is the breakout method? It breaks the level, the price closes above it, and we enter. So these are both methods. We also discussed their advantages and disadvantages and the way to trade them, and you can also see their pictures in the slides.